How to lose money in the stock market by Miles Talks Finance. No, not really. This video is about how to make money in the stock market. You can see right here, options account up almost $8,000 by Miles Talks Finance. This is two strategies in one video. We have Theta Gang on one side, Robinhood on the other. Boring strategy we'll go over first. This is the wheel strategy in case you couldn't tell. Basically what you do in this strategy is you sell a put against the stock. If 100 shares get assigned to you, then you sell a call against it, and then you lose those 100 shares because your call was fulfilled, and then you sell puts again on the same stock, essentially running an ever-going wheel. I was looking around for stocks to run the wheel strategy on. Adobe stock looks great. I'm going to buy 100 shares. Stop. Do not buy those 100 shares. What you want to do is sell puts on Adobe to where you're selling a contract saying that if Adobe stock is at this price at said expiration date, then you will be assigned 100 shares at that price, and then you get paid the premium for opening that contract. I took a look at marketdash.io. They're a great service. They offer a 7-day free trial. Use my affiliate code down below. You click on that link and sign up. No obligation to you. If you do enjoy it, keep using it. I've been using it. Very great information. I see that, on their technical analysis portion of their website, I found that Adobe seems to be undervalued. Adobe seems like they have a lot of upside right here, and I'm going to sell a put against Adobe. That's obviously what I'm going to do because that's the best thing to do right now. I'm not going to buy the stock because I want to own it for a cheaper price, and I want to get paid to buy the stock for cheaper. That sounds amazing. So basically what you do to run the wheel strategy, as you see, this is a screenshot from Robinhood here that's what I use to trade. It's very similar on every, broker. You guys probably know how to trade options if you're on this video. I'm sure you do. But if you don't, then you just open up the option chain and then you'll go to sell and then you'll go to put. So basically, for Adobe, essentially I'm selling a $320 put. So if Adobe's price at set expiration date, which for this one is 11/28, so this is November 28th, and this is usually best. The premiums are best when it's between 30 and 45 days. That's the best balance of premium to time ratio from what I've seen. So I'm selling a put on Adobe for $320. The collateral that I'm getting, the premium that I'm collecting from this, is I'm getting a flat fee of $735. No matter what happens, if I hold this contract until expiration, I will get $735. That's what's going to happen. If Adobe never hits $320, then I'm never assigned shares. If Adobe goes up, then I'm not assigned shares, and I get to keep my $735. If Adobe's price is above, if it's $320.01 on the day that my contract expires, at that time, then I get my $735 and I'm not assigned Adobe, and I can keep selling puts for cheaper because the premium will be higher on those cheaper puts, and you guys will get it more when we go into it. But let's say Adobe actually is under $320. Here's 100 shares of Adobe, my friend. Now we have to sell calls against Adobe. So we sold puts against Adobe, which we just saw. So since we were selling puts, we got assigned 100 shares. Now we're selling calls. We're saying that if Adobe, like here, if Adobe hits $355, then they have the right, Robinhood has the right to sell all of my shares at $355 for me. And I'm going to make money because I got into Adobe at $320. And I got the $700 premium. So the price that I actually got Adobe for is much cheaper. You can see the break even here is $361. So Adobe could be under $361. You still get assigned, even though Adobe went up. You have to sell all your, shares, but you also get more premium than you would have made from just selling the shares. So there's a lot of things to take into consideration with this. We see right here the max profit. So you get, even if it doesn't hit $355, if Adobe stock goes down $20, you still make that $630 premium. The pros of this strategy, it's not a very complex strategy. You guys probably understand it just from that. There's not much risk associated with it. If you are buying a stock that you're going to buy anyways, you're basically just taking on less risk, essentially. You're buying the stock for much cheaper than you were going to buy it for already. Another pro is the ease of use. This is a very easy strategy, not much moving parts besides the wheel. There's not really much going on with this one. It's just a lot of, paying attention to the stock's price. Do I actually want to own this stock? And there's a lot of flexibility. You can roll these calls. You can, sell them for different time frames. There's a lot of things you can do with this strategy that make it more complex. These are what some, more experienced traders do, but at the end of the day, you're still running the wheel strategy. The cons of this one is you need a lot of capital. If we go back here and we check Adobe's stock price, we can see that Adobe's stock price is $333. You need 100 shares of it. So we had two zeros after that. Essentially, you need $33,000 to run the strategy on Adobe. So you can take smaller stocks, $10 stocks, you need $1,000 for the strategy, and so on and so forth. $100 stocks, you need 10,000. So it's a very capital intensive strategy. A lot of people run this strategy on ETFs because over time ETFs do usually go up. I didn't say it. So it can get very easy to chase premium with this strategy. You could sell a put essentially for Adobe. You could sell that put just $5 under the stock price of what it is right then and there. But then let's say the stock drops $20, now you're in the red. Now you own Adobe for a lot more than you should have because you were chasing premium. You can't do that with this strategy. You need to stay true to what delta you're comfortable with, what your risk tolerance is. You can see the deltas next to all the options on the option chain. If you guys check, delta is essentially the percent, the chance that it'll break, in the money. So yeah, you guys need to check your own risk tolerance for that. Basically, the higher the delta, the more likely it is to happen. The lower the delta, the less likely, at least on the call side. On the put side, it's the exact opposite. It's negative. So you guys can take what you will with that. And then also you can miss out on a lot of gains. So let's say that I do have 100 shares of Adobe at $320, like my selling puts. I got 100 shares of Adobe at $320. It was at that price exactly when, the put expired. So now I have the call, and then Adobe shoots up. Adobe hits $450. I missed out on $100 of 100 shares of Adobe. All I got was the gains from 320 to 355. I missed out all the way to 455. So there's that to take into consideration as well. But at the same time, if Adobe drops, I'm getting paid $630 just to hold it. But now we're on to the fun strategy. This one is very similar in the sense that you're doing the same thing, but it's a little more fun. So this is a poor man's covered call. As you can see, a poor man covered call. This is essentially the wheel strategy, except you are buying a call instead of buying shares on the stock. So it's same as the wheel, but it's just for Robinhood users. It's for people with a little less money like you and me. The profit loss chart of this is the loss area. You have a limited downside risk because your risk only is the price of the call option, combined with the collateral that you're getting from the premium of selling a call against that. That might sound confusing right now, but we're about to get into that. So you do have limited downside risk. You also have limited upside profit. That is how things seem to work in the stock market world, is it goes both ways. So is this a good buy? Yes, we look on Market Dash right here. Adobe is a great buy right now. It's undervalued. Its intrinsic value is $20 more than what the share price is right now. Great information to have. I'm going to buy some Adobe. But I can actually buy a call on Adobe. So essentially what you want to do is buy a leap. A leap is classified as an option that you're buying an option. This one I bought in the money. It has a delta of around 70, which I suggest to do. You want a 70 to 80 delta when doing this. The higher the better, as much as you can afford to do for this. This option in particular is $8,000. In comparison, buying 100 shares of Adobe would be, what it is right now, $333. It'd be $33,000. So I'm saving a lot of money by buying this option. When I buy this option, we see that it's, $8,000, $300 call. It's in the money. And I'm saying that it's going to expire next year, November 20th. So I have a lot of time. This is definitely a leap. I'd suggest buying more time than less. Paying for time on options is very beneficial, and we'll get into why that's important for the strategy very shortly. So I bought an option on Adobe. I own 70% of a share times 100. That's how delta works. That's how much you own of this. So now we're going into Adobe with that assumption. I'm going to make a lot of money, right? Right, but it's capped. So what you do with this strategy is now I'm selling calls against my Adobe, poor man's covered call, basically. So what we were just doing right then, the wheel strategy, is covered calls. When you're assigned the put and you have the stock, you're selling covered calls against them. That's what it's called. So this is a poor man's covered call. Robinhood and stock trading apps allow you to sell calls against your bot calls, technically. So even though you don't own a full share, because the delta is, making the share, if you have, this call is 70 delta, you basically own 70% of a share times 100. So it's still letting me sell calls against my poor man's covered call. And we see the profit chart right here. The gains are capped. Also, the losses are capped, which is great as well, because the stock price technically could go to zero. If I just have an option, that means that my $8,000 is going to zero, but I'm still collecting the premium of this, which is $630. So that's great. And when you are selling options on this, you do want to make sure that it's between that 30 to 45 day period and not a year out like your leap is for buying the call. And we see that right here. Like I said, on the profit chart, your earnings are capped on the upside, but also capped on the downside. And you can keep rolling this over and over again until your leap expires. And hopefully you make a lot of money with your leap and your covered call, and the stock is gradually increasing just right before you see your max profit is, right here, right before Adobe hits that 355. If it's $349.99, that's how you're going to make the most money, because you get to keep that premium and you keep your leap that gained value during that time period. So basically we see right here as well, the max profit is $2,149 and the max loss is $6,696. So do I like these odds? Yes, I like these odds a lot, because if the leap drops a little bit, you can still make money with the premium here. You're probably making more money off the premium. And let's say the leap just absolutely then that's worst case scenario. But also the leap can blow past this and you get to keep the premium. You keep the money that you made from the leap. I mean, it's basically, it's not risk free for sure. The stock can still go down, but you're very much mitigating your risk by selling calls against your, even if you have leap options, selling calls against them is a great way to decrease your risk. This is a very good strategy, especially if you don't have a lot of money. I mean, this is a lot of money. The cheaper the stock you do this on, it'll be a fraction of the price. You saw the $33,000 stock you can trade this strategy for with actually only $6,696, because when you open the trade, you open it with the selling of the other call, which actually discounted this $630. So the pros of this strategy is you can buy very expensive stocks for cheap. You can buy Adobe for $8,000 technically and sell covered calls against it, and you're basically owning 100 shares of that stock and selling covered calls against it, which is very great, especially for $8,000. You get a quality stock that's worth a lot more. There's quick and attractive returns. So the return profile on this is very great. You see the risk is basically you're losing 2/3 or you're making a third. And that's max profit, obviously, but that's just off the leap. So let's say that your max profit hits you just, you go right under 355, the stock gained value, it's 350 now. Okay, then I'm going to keep my leap. My leap gained a lot of value, and now I can sell a call for 380 that's going to also give me $600 in premium. So your leap is going to gain more and more value over time. Buying undervalued stocks with these leap options is, honestly, one of the best strategies in the stock market with a small account. And then also another pro is this is long term. This is, you can hold this for a while. Your leap doesn't expire until a year, so you have a while for the stock to recover. If it for some reason does drop right away, hopefully that doesn't happen. You're buying a stock that's already pretty beaten up and the stock market's good to you. I hope that is the case, but there is a possibility with this. The cons on this one, it can go under fast. If you buy a leap and then the stock drops 20%, remember, options are very leveraged. So other than shares, options are going to move a lot more in one direction or the other. This is good and bad. So if your option goes up, it's going to go up a lot. If it goes down, it's going to go down a lot. So you can go under very fast with this one. And then you're selling calls all of a sudden against your leap that are losing you money if they actually get fulfilled. So that's not a fun position to be in. Your gains are capped. Let's say your leap is, let's say Adobe all of a sudden tomorrow, 3X's. Let's say Adobe hits all the way from $320. Let's say it hits $1,200 or $900 or $1,000. Let's say Adobe hits $1,000. You missed out on so much. If you had just had a leap for Adobe for $300, a $300 call, and then it hit $1,000 all of a sudden tomorrow, you'd have a different life. Your life would be changed if you bought that leap. But you have the $355 call that capped you at $355. Every penny made after $355 is not there because you agreed to sell your shares, which your shares are held in a call right now, for $355 dollars. If it's at $355, you're getting that premium of $630, and you're not getting anything past that. That's the most you're getting. So that is a con for this one. And then also expiration. You can't hold it forever like shares. Yeah, you're missing out on stuff probably if you hold shares of a company that's not doing great, but you can still, hang on to that copium and hold on to that stock and have, Adobe for $1. You can still hold the stock for $1, even though you lost all your money pretty much. You still have 100 shares of Adobe to sell calls against. So with this, if Adobe is $1 in a year, you're, on 11/28 on the expiration in 2026, you have to sell it no matter what, which is, kind of rough. But that's all I have for today's video, guys. If you did enjoy, be sure to smash that like button. Also, subscribe to the channel. I really appreciate your guys' support. I wanted to come at you with something a little bit different today, a strategy video, not really talking about a stock in particular. I do think that Adobe is a good stock to run this on, honestly. If you have $8,000 in your portfolio, I don't think this is a bad thing to do right now. I think that the economy and, that's looking like maybe it's going to take a different direction. But I do think Adobe is so beaten down already that it could be pretty good for the strategy. So if you guys did enjoy this video, like I said, be sure to like it. Helps me out a lot. It's free. It's $8,000 to do this option strategy on Adobe. It's free to like this video. It's free to subscribe to me and turn on post notifications. Thank you guys so much. I'll catch you in the next video tomorrow. Peace.